If someone handed you $20,000 tomorrow and said, do nothing, you can live off it for a month, would you feel safe? Or would you instantly realize the truth nobody trains you for? In 2026, money is not scarce because people do not work hard enough. Money is scarce because the system is designed to make you keep trading hours for survival while other people trade credit, leverage, and ownership for freedom. This is not financial advice. This is financial education, the kind you only hear when someone stops pretending and starts showing the mechanism. The mechanism is what matters right now because AI is accelerating job displacement faster than anyone in human resources can explain. Inflation may cool on paper, but your paycheck still buys less than it did in 2019. Housing prices in the United States, the United Kingdom, Canada, and Australia have detached from wages so hard that a whole generation is learning a new skill: how to rent forever without falling apart. And while you are drowning, the stock market keeps sprinting toward record highs. That disconnect is not a coincidence. It is the result of how wealth is created and how it is defended. Today, I am going to walk you through the core idea behind modern financial power. Not the motivational version, the actual engine. You will hear words like leverage and credit and circulation, and you will see how they show up in places you have been taught to ignore. Your bank statement is not the battlefield. The battlefield is the structure behind the bank statement. And once you understand that structure, you can stop blaming yourself for not getting rich while pretending the rules are fair. First, let's destroy the first lie. Financial freedom is not earning money. That is just the warm-up. Real financial freedom is owning assets that pay you while you sleep, breathe, and wake up annoyed at the world like everyone else. If you need $20,000 a month, you need $240,000 a year from something that does not clock in and does not ask for a raise. Now here is the part that makes people uncomfortable. You cannot magic $240,000 a year from a paycheck. You need a pile of investable value. Suppose you can achieve a 10% annual return before we even argue about what 10% really means in the messy real world. 10% of $2 million is $200,000 a year. You see how the math forces the truth into the open. If you do not build assets worth around $2 million, you do not get to retire early. You get to keep working until the body quits or the bills win. And that leads to the uncomfortable question: how do average people ever build that kind of capital? The answer is not save harder. That advice is propaganda for people who do not want to learn how the rich actually play. Saving is good, but saving alone is not leverage. Saving is a single lever. The rich use leverage, credit, ownership, and time. They also use the part you are never told in school: other people's money is a resource and credit is an amplifier. Pattern interrupt here because this is where most people stop listening. In 2026, the biggest amplifier is not a spreadsheet. It is the ability to borrow cheaply and the ability to buy assets that appreciate while you are still paying rent. When the Fed cuts interest rates, it does not cut your housing costs overnight. It changes the financing environment for asset holders first. If you own a home, the mortgage might refinance. If you do not, you still pay whatever landlords and supply constraints demand. If you own stock in a diversified account, you are riding asset inflation. If you do not, your savings account gets crumbs. You can watch the interest rate announcements and still feel powerless, because the transmission mechanism of monetary policy is unequal by design. So let us talk leverage in plain English. Leverage means you take a small amount of something and control a larger amount of something else. In a clean world, it is a tool. In an ugly world, it is a weapon that the system gives to people with access. The old metaphor is Archimedes asking for a point of support to move the world. The support might be cash, or it might be credit, or it might be a network of customers, or it might be legal ownership that lets you borrow against future income. And leverage is not automatically evil. The moral argument is too lazy. The real argument is this: leverage is only dangerous when you do not understand your downside. And most people do not understand their downside because nobody teaches them how to structure risk. They are taught invest responsibly with vague slogans while they are quietly handed contracts that transfer risk away from institutions and onto households. Here is a micro story that is painfully realistic. Picture a 32-year-old nurse named David. He works nights. He has always tried to do the right thing. He pays his bills on time. He has a budget. He even contributes to a retirement plan at work because he believes in the idea that slow and steady wins. Then in 2026, his health insurance premiums increase again. The grocery bill does not care that the news says inflation is down. The real cost is still climbing. David looks at his rent and realizes that one room in his city now costs the equivalent of his entire take-home pay from 2 years ago. David tells himself a story that many people tell themselves: I just need a side hustle. I will learn a marketable skill. I will do something with AI. He thinks AI will help him, and sometimes it will. But the bigger reality is that AI is already helping other people do his job faster, cheaper, and with fewer humans. Meanwhile, the nurse who owns rental property down the street is not being replaced. Their tenants are being replaced. That distinction matters. Now, do you see what leverage looks like in David's life? He has wages. He has no assets that can borrow against. He has no credit line large enough to buy a cash-flowing asset. He is trying to create leverage with hustle instead of ownership. That is why he feels exhausted all the time. He is stuck on a treadmill with no way to step off. So let's rebuild from the foundation. The core engine that creates wealth is not working hard. It is three connected moves. Buy or control something valuable, amplify your control with leverage or credit, and increase circulation so the asset produces more value per unit of time. If you only understand one of those moves, you will still feel poor even if you get smarter. You need the whole system. Leverage first. There is a reason the rich look like they get lucky and you look like you failed. Not because the rich are geniuses, because they have access to leverage that converts ordinary cash flow into asset growth. When you see a wealthy person buying another property, they are not risking their entire life savings like a gamble. They are often using existing assets as collateral. They are borrowing at rates that are unavailable to you. They are converting future income streams into present-day buying power. Now, credit, in this story, is not a moral trait. It is a mechanism. Credit is the ability to borrow now against value you do not yet have. And in every major economy, credit is the lubricant of capital formation. Without credit, the system freezes. Without credit, expansion becomes slow and limited to people who already have cash. But with credit, growth accelerates for whoever can access it. And here is where you should get angry, because you have been lied to. People tell you that if you are disciplined enough, credit will reward you. That part is true. But the crucial missing detail is that credit is also rationed. Access to credit is gatekept by income, history, assets, and the kind of narrative lenders think is safer. If you are a wage worker with no collateral, your credit score is a thin ticket. It can help you refinance a car or qualify for a credit card. It cannot turn you into a large-scale buyer of income-producing assets unless your wage income is already high and your debt is already low. Pattern interrupt number 2. In 2026, the big systemic divide is not education, it is balance sheet structure. AI is reshaping employment, and it is also reshaping the labor market in a way that rewards asset ownership. If a company can replace mid-level tasks with software and automation, they can cut headcount. If they do layoffs, your wage base shrinks, but their balance sheet expands if they use the savings to buy assets. Meanwhile, top wealth holders can borrow against their appreciating assets even when the economy is uncertain. So they get to wait out volatility with liquidity. You wait out volatility by paying bills. Now, let's turn leverage into an actual method, not a slogan. One simple template is this. Treat cheap marketing and future customer spending as collateral for building an asset. Think like a business owner, not like a consumer. Imagine a car wash and detailing shop. On the surface, it sounds like simple service revenue, but the shop owner you never see in your newsfeed has a different objective. He is not trying to make money only from washing cars. He is using the car wash as a funnel to capture repeat customers and convert them into membership revenue, which is cash up front or at least predictable. He does something that looks like a gimmick. He advertises free car washing for a year. People show up hundreds of cars a day. He is not paying for washing from nowhere. He already has labor and overhead planned. The real trick is the membership. To get the free washes, customers must pay a membership fee. Now you suddenly have cash flow at the beginning of the relationship instead of after the service is delivered. But that is still not the end. The next move is to take those membership accounts and use them to support a separate revenue line or a financing line. The shop owner might partner with an auto insurance broker so he earns commissions, or he might create a small lending or installment offering with clear underwriting. The key is that the shop owner is stacking income streams, service revenue, membership revenue, and partner commissions. The leverage is not only financial, it is operational leverage and customer concentration leverage. And the most brutal part of this story is that people who want to copy it often misunderstand the sequence. They see the free washes and think they can do that. They cannot. They do not have the customer base. They do not have the volume economics. They do not have the operational discipline to handle hundreds of customers daily without bleeding cash. They do not have the legal and credit structure to make the next step possible. Leverage is not a magic trick you perform. Leverage is a system you build. Pattern interrupt number 3. In 2026, People try to copy the wrong parts in every industry. They see the surface of passive income and they ignore the assets. They see a social media creator with nice cars and they think, I want that. But the truth is that most content income is either inconsistent, sponsored, or produced by a small group while the platform takes the majority of the value created. A lot of creators end up making near $0, not because they are untalented, but because distribution is monopolized. The system rewards scale and retention, not effort. And if you do not own audience, and if you do not own underlying income streams, you are not building an asset. You are building a distraction. Now let us talk about the leverage multiplier that banks use, because that is where people's intuition breaks. Banks do not just use your deposits to make loans and hope. They use leverage through balance sheet scaling. They borrow and they lend, and they do it at scale. A bank can have a relatively small amount of true capital and control an enormous amount of assets because it can borrow cheaply and because regulation allows it to use risk-weighted capital requirements. That is the legal version of leverage, and it is why the largest financial institutions can print profits when the economy cooperates. But ordinary people never get the same privilege. You cannot scale a bank with a few $1,000s. You cannot borrow at deposit rates. You cannot securitize your salary and turn it into 90 times the controlling power. That is why the wealthy appear to win during booms. They have the leverage instruments. You have a paycheck. Still, ordinary people can learn the principles. You can use leverage in real estate by putting down a deposit and borrowing against the property. That is leverage. You buy with a fraction of cash. If the property increases in value, your upside is amplified relative to the down payment. But the downside can also be brutal. If the property value drops or tenants stop paying, the leverage cuts both ways. That is why you do not play leverage like a lottery ticket. You play leverage like an engineer. You plan for stress. Here is another micro story, because abstract concepts are only useful if they stick to your brain. Imagine a couple named Maya and Jordan. They find a small rental property they can put a down payment on. They get a mortgage, they rent it out. They pay the mortgage with rental income, plus a little from wages. For a while it works and they feel smart. Then insurance premiums rise because climate risks are becoming real in many parts of the country. Property taxes rise too. A tenant moves out. They lose a month of income. Repairs arrive like a bill from the past. In the old fantasy, the property was an investment that keeps going up. In the real world, leverage turns uncertainty into monthly pressure. Maya and Jordan survive because their emergency fund exists and because their tenants are reliable. If they do not have those buffers, leverage becomes a trap. The rich do not avoid stress. They just have more options when stress hits. And now we reach the next concept: circulation. A lot of people think value comes from location alone. They think real estate is valuable because it is land and buildings. That part is true, but incomplete. The higher-priced properties are usually the ones with faster circulation of people and money. A farm might produce value slowly. A factory produces value on a manufacturing schedule. A retail center produces value every day because customers physically move through it, spend money, and generate repeat transactions. That idea is transferable to human income. Your circulation is the speed at which you convert your time, your knowledge, or your assets into transactions and value. If you increase circulation, you increase throughput. Throughput creates profit. If you are a regular office worker and you try to increase income by working longer hours, you increase circulation, but you also burn yourself out. You eventually hit the body limit. That is why the smartest increase circulation through transferable skills and scalable delivery. If you know a specific domain, you can package your knowledge and teach it to a paying audience. Not because you suddenly become a guru, because knowledge can be reproduced. It spreads through internet distribution. That is a kind of circulation with low marginal cost. You can build a course, create templates, produce written guides, or host a small community. You get paid from a single asset multiple times if you structure it well. But here is the darker truth nobody admits. The creator economy illusion sells freedom while most people earn almost nothing. Platforms can change rules overnight. Ad revenue can collapse. Brand deals are not guaranteed. And AI can generate content that competes with your output. So knowledge as circulation only becomes real wealth when you build something that is not entirely dependent on algorithmic luck. You need durable distribution, relationships, and potentially a product or service that converts attention into cash flows you can rely on. Now connect this to AI in 2026. AI is replacing parts of jobs that involve routine cognitive work. It can also replace parts of content production. That means the advantage shifts to those who control ownership or those who control distribution with an asset-like structure. If you are building a brand that only lives inside a platform, it is not an asset. It is a lease. If the platform changes, your income changes with it. Now let's talk about retirement because it reveals the same structural lesson. Social Security is underfunded, pensions are under pressure. People in their 40s and 50s are told to delay retirement and in many cases to work longer because the system is running out of runway. Meanwhile, the cost of living keeps rising. When you delay, you trade more years for the same purchasing power, which has already been damaged by years of inflation. And the financial system does not treat you as an owner. It treats you as a worker with a pay cycle and a vulnerability window. You are vulnerable because you have to keep earning. You cannot stop working without losing housing and healthcare. The rich are vulnerable too, but their vulnerabilities are usually buffered by assets and credit. They can borrow against assets and ride volatility without selling at the bottom. So when you ask why does the system feel rigged, this is why. It is not that every individual bank